Okay, hey, greetings, everybody. Here we are at the beginning of November, almost a 1 year anniversary for joining Allworth. And we thought that we would do something a little bit different and do a little video update for all of our clients. We officially joined Allworth on December 1st of last year. So we're almost at the 1 year mark. And we thought it would be nice to update everyone with a video discussing a lot of the changes that have happened and all the positive things that are going on inside the firm right now, as well as inside the Tucson office. I'm Brian Murphy. You all know Blake Davilar. We are happy to come to you today and share some thoughts and ideas about where we are and where things are headed. And so, Blake, what's on your mind about some of the changes since we've joined Allworth?
Yeah, 2021, there was a lot that happened, both in the world and here at our Tucson office for Allworth. So I'd say, the dust has settled. It was a lot going on there at the beginning of the year with the transition. We thank all of our clients for sticking with us through that transition. And I think it's brought a lot of enhanced benefits for our clients, including a deeper team of tax professionals, financial planners, investment departments, trading and operations teams, which was a big one for our office here. So it's really freed up both of our times to focus on what we enjoy doing most, which is helping serve our clients and help them make smarter financial decisions. So, there's a lot to come. Allworth is a very fast-growing firm. They're introducing a lot of new and exciting features on both the investment side and the financial planning side of things. So we're just going to kind of give you an update on what's happened in the last year or so and kind of what's looking forward into 2022 as well.
That's great. So what would you say? I think you hit on some key points there. We have a deeper bench in terms of tax. We have a deeper bench in terms of estate planning, a deeper bench in terms of the investment team, the trading team. Of those, what are the couple that you're seeing the greatest benefit from to free up our time and also to benefit clients?
Absolutely. A couple come to mind. The tax piece is huge. We're going to see some tax changes likely next year, and we can't be an expert in all things. We know enough about tax to be dangerous. Now we have CPAs behind the scenes that can work directly with our clients to not only help them optimize last year and make sure that their filings and all that go smoothly, but also help forecast forward, discussing things like Roth conversions for our clients that are maybe nearing retirements and where they're in an income picture where that makes sense. Also looking at maybe some more unique things, like I was discussing stock options recently with our tax team, which we don't see every day here in Tucson, but that's a big benefit for where it makes sense. And really having an expert, things that we don't see every day, somebody that we can call for those kind of off the wall, more unique type situations and questions is a real added benefit. Secondarily, I would say the operations piece is huge. Having that team of traders and helping us implement widespread portfolio changes, rebalancing, which we talk about all the time. Last year in March, we, of course, rebalanced all of our accounts. We talked about it on other podcasts and during our meetings as well. And that took us several days, hours each day. To
8 or 10 hours a day for an entire week.
Looked at every single account, because we can use technology to an extent, but overall you got to get in there and really look at, because every account's a little bit different, every situation's a little bit different. Anyway, now with the centralized trading team in Sacramento, we can really scale our trading and rebalancing process to where it's quicker, it's more scalable, it's easier, and it's better for everybody involved. So that's been a huge lift.
Yeah, I think that's one of the key benefits that we've gained is the trading, and I think that ties itself directly to a discussion of portfolio construction. As most of our clients know, DFA, Dimensional Fund Advisors, introduced a complete suite of ETFs or exchange traded funds beginning in November, I think, of last year. And we're actually going to see, I think it's 4 new fixed income funds that will be introduced between now and year end. So pretty much the entire DFA lineup will have been replicated with exchange traded funds. We worked very closely with Andy Stout on our investment team, who in turn worked with us and closely with the folks at Dimensional Fund Advisors to engineer those changes in portfolio construction. But Blake, why don't you touch on some of the benefits that ETFs offer relative to the traditional open-ended mutual fund structure and kind of how we went about that process and some of the things that might be happening between now and year end?
Happy to. DFA, as you mentioned, Brian, continuing to launch more and more options in the exchange traded fund universe. They are typically offered at about 50% lower cost, lower fees. So that's the main benefit. They're cheaper for DFA and other large investment management firms to operate an ETF versus a traditional 40 Act, which is an industry jargon for a 1940 Act that was passed that kind of created or launched the mutual fund industry. So now the ETFs have, if you look at the flows, which we do on a regular basis, where's the new money going? 80 to 90% of it's going to ETFs.
Right.
For the reasons behind that are several, but lower cost, huge, transparency, daily liquidity. It trades all day long on an exchange. It's really garnering more and more share of the market. And if we can replicate the exact same investment experience for our clients at a 40 to 50% reduction in cost, we're going to do that. So look for some changes there as more options become available in that space.
And I don't think we could understate there are compelling tax benefits to the ETF structure as well. So why don't you address that?
Yeah, good point there. If you have been an investor in mutual funds for a while in a non-retirement accounts or in a joint account, a trust account, or brokerage account, regularly there's capital gains that are passed through to the end investor. So you own, say, a mutual fund that owns US stocks. Well, every year that fund company might be buying or selling different stocks throughout the year. And those gains are then passed through to you as the investor. Even though you might not sell that fund, you still might have some tax obligations at the end of the year. Well, the ETF structure, we're not going to get into the details of how the sausage is made, but essentially it's a more efficient tax structure where they don't have to pass through those gains to you as the end investor in any given year. Only when you sell it, of course, the gains would be to at that point in time, but in terms of buying and selling stocks as a fund company throughout the year, they're able to exchange those securities with other funds and negate any potential or most tax impact to you as the end investor.
Yeah, so they're much more tax efficient, lower taxes overall to a taxable investor, and that's compelling as well. Now, since we're on the subject of taxes, we might as well look forward a little bit.
Yeah, sure.
Our friends in Washington have been working diligently to affect some changes in the tax laws going forward, which could have a really big impact on some of our clients and many Americans, particularly those who have large IRA balances and large balances in qualified plans, where they'll be getting bigger RMDs or required minimum distributions. But why don't you talk a little bit about the upcoming or shall I say potential changes to tax laws that have been discussed in Washington lately?
Yeah, potential being the key word there. It'll constantly be a changing process until something's put into law here. But some of the things that we're hearing and that we're planning around right now include things like Roth conversions, for where it makes sense tax-wise, taking advantage, if you will, of the lower tax rates while they're still here. Estate law changes are a big consideration right now. The exemption is north of $20 million, so doesn't impact most Americans, but there's talk of that lowering potentially next year. maybe even dropping all the way down to 5 million where it used to be a number of years ago. So with an exemption going from 20 to 5, well, all of a sudden many of our clients are potentially impacted by that change. So talking to your estate planning attorney, coordinating between our team, the tax team, and the estate planning team, having that conversation and talking through some of the strategies and maybe priorities for our clients is something we're doing a lot of. And running Roth conversions, I'm probably doing 2 or 3 of those a week right now. It's a great legacy planning tool for kids and grandkids, and also for longevity. People are living longer. We have several clients in their 80s and 90s, and not uncommon to see somebody reaching 100 even today. So that the long life expectancy during retirement, you can kind of take advantage of the Roth conversion, and having some after-tax or tax-free money in the future with those earnings can make a big impact down the road.
So it's safe to say then, in my opinion, that we will have some changes, and certainly the sunset provision, which will roll back the exemption on estates to the prior levels, is inevitable. Something more or less could happen in between now and then. So the Roth conversion is a great tool. So walk us through, for those who may not be familiar with the term Roth conversion, how you actually take money out of an existing IRA, put it into a Roth IRA, and what the benefits might be, and how we typically invest that money for our clients.
Great question. So we really roll up our sleeves and look at a client's projected adjusted gross income for any given year. So what their income is from all sources, let's say, that's taxable. And we run that by our tax team and say, do we have any room in, say, the 12% bracket or the 22 or 24% bracket? Kind of somewhere in that range. How much do we have until we progress into the next bracket, if you will? And once we kind of determine that, we then look at converting a little bit of their pre-tax IRA money, qualified money as it's often called, transferring 10,000, 20,000, 50,000. We've done some as large as 100,000 over into a Roth IRA. And the downside is you owe tax. That entire amount becomes a taxable event. But if we can do that and lock in a tax rate of, say, 12% or maybe 22%, long term, we think historically, it's a fact that that's a pretty low tax rate to pay based on where tax rates are today, where they've been in the past, and where they might be headed in the future. So that is kind of the strategy in a nutshell. Once the money is in the Roth account, once that 50,000, let's say, to use that as an example, is transferred into the Roth account, it can then be invested, and you leave it alone for 5 years, and then all the earnings in that account are tax-free. So with that,
and all the withdrawals are tax-free.
All the withdrawals are tax-free. And any amount that you transfer out of that IRA, out of that qualified account, it lowers future required minimum distributions, which now come into play at age 72. So two benefits, right? You lower your future tax hit from those IRA accounts with required minimum distributions, and you create a tax-free asset for you, your spouse, or your family for the future. And given that the Roth IRA for most of our clients is a relatively small account in terms of the big picture, and we know that there's a huge benefit to the tax-free aspect, and it's oftentimes the last asset we touch for retirement planning purposes. Let's invest that more aggressively than the rest of the picture. Still keep the risk tolerance and overall portfolio the same, but we can maybe de-risk a little bit over here where it makes sense and increase the growth and risk in the Roth IRA and really try to grow that thing, because we know everything is tax-free after it's in that account.
Absolutely. So if you think about it, a couple of the big benefits are, it's a small percentage relative to the overall household portfolio. So you can still keep the overall structure the same, but invest that portion more aggressively. And then on top of that, you think about, a lot of those Roth IRA dollars will likely be transferred to the next generation. And a lot of times when you're in your 80s and moving on to the next phase, your kids are maybe in their 50s, they're in their peak earning years, and they may be at that point in time, in a much higher tax bracket than you are now, or they are now, even because they've come into their stride in their career, and now they're in a very high tax bracket. So to get those Roth dollars in a tax-free mechanism is very compelling to pass on assets to heirs tax-free. So it's got a number of benefits, and I think one of the key components there is we have the financial planning team helps us to run those illustrations and those simulations. And then if we have a complex case, we can chat with the tax team and say, okay, here's an individual that may have a number of properties with some depreciation and passive income plus a W-2. Help us analyze this so we don't give bad advice and tell somebody to do a Roth conversion when in fact it might put them in a higher tax bracket. So we have more resources there, just like we do on the trading team. Some of the trading that we did, I want to say, was it February or March, where we began to move our clients in their qualified accounts to the new DFA ETF portfolio structure. We basically executed that in a day, where it would have taken us at least a week.
Yeah.
In order to get that accomplished previously. So that's a pretty big advantage as well. Talk a little bit, if you will, we're in a very strange economic cycle. Today, we're on the heels of visiting with a number of our larger corporate clients in Southern California who are really struggling with where we are in the economy. You want to talk a little bit about that and how that relates to our clients and how that relates to our view of capital markets and the economy?
We were down in Newport Beach and went out and had some lunch right near the pier and looked out. It was a clear day, and the floating container ship thing is real. There was at least a dozen, maybe more, big floating container ships waiting to get into the Port of Long Beach or Port of Los Angeles, wherever they're headed. There's a huge backlog. People can't get the materials, the products. If you're doing a home remodel right now, that firsthand. Many of our clients out in Southern California can't get the resources and materials and equipment they need to conduct their business. So it's a real issue. And of course, inflation is talked about all over the place right now in both economic circles and in everyday life. Higher gas prices, higher grocery prices, higher home prices, et cetera, et cetera. Social Security benefit for the first time since the 1980s is going up by over almost 6%, 5.9% increase. So yeah, there's a lot going on. Interest rates still remain very low. The Federal Reserve has talked about their bond buying program and potentially raising interest rates as soon as next year. So what do you see, Brian? What's going through your head right now when it comes to the state of the economy?
Well, I always kind of say the same thing. I mean, cycles are inevitable. Economy will get hot, the economy will go cold. Markets will be hot, markets will go cold. And that's not an evasive answer. The fact of the matter is, the discipline that we have and the approach to managing portfolios that we have, which, by the way, is one of the key reasons why we joined Allworth. They share our rebalancing discipline, so that if the stock market portion of your portfolio drops by 5%, we're going to sell bonds and buy stocks. By the same token, if the stock market portion grows by 5% relative to the total, we're going to sell stocks and buy bonds. And so I think one of the things that resonated with you and I when we joined Allworth was the fact that their rebalancing that had happened before we joined them was identical to our own. So being on the same page in terms of investment philosophy was a crucial element in our decision-making process. But I think more importantly than that is that, great, there's somebody in the background every day when you and I are, going from San Diego to Los Angeles, meeting with clients for 3 or 4 days. it's not like nobody's watching the store. The store is being watched very closely by the trading team, by the investment committee, the portfolio management team, and that gives us peace of mind, and in turn should give our clients peace of mind. On top of that, and I think equally important, we have spent more time face to face with clients this year than we have in a long time. Well, part of that is COVID. We basically shut down for a year. But the other part of it is we don't have to do a lot of those things that we used to do in terms of, let's say, rolling up our sleeves and getting our hands dirty with, the financial planning piece or the Roth conversions or the back office component. And it wasn't like when we had a tax question, we would call a CPA and beg for an answer. Now we have a team that we can actually call and say, hey, if we do this conversion for so-and-so, what are the implications going to be? And that's been a real benefit to us. But the true benefit is more face time with clients.
Yeah.
I didn't get in this business to negotiate copier leases and pick out furniture and all the things that you have to do as a business owner. Those things have now been delegated. They're off my plate, and I find that I'm able to spend a lot more time with my clients, and you and I do a lot of that together. So I think that's been a real benefit too. Do you want to address a little bit what's going on with you and how your client base continues to grow?
Yeah, increased capacity has been a huge benefit. So we get to help more people. And we're looking to add another team member here in Tucson in the near future. We're working with the team at Allworth to try to find what that role is going to look like and how they're going to help us here in the office. So we're growing and increased client capacity, continuing to meet with new clients every week, which is exciting. We get to help more people figure out their financial plan, their retirement strategy, investment help, all those things. And it's pretty exciting.
Yeah, it's great. And we have received a lot of positive feedback from our clients as well. We want to thank you for that if you're one of those folks who's let us know. It's great to have made the change, feel comfortable a year later, and be receiving positive feedback from clients. So it's been a win-win-win all the way around. I think we've really covered most of the high points. Are there any things that I haven't addressed that you'd like to address, Blake?
I don't think so. We're here. If you ever have any questions, don't hesitate to reach out. Of course, you know where to find us. We really want to thank you all again for sticking with us through this transition. There's a lot of great new things that are in our disposal and in our arsenal that we can help serve our clients better. And things are always going to change, right? That's inevitable. And we have a team of people now that are helping us think through those changes, both in the economy and in Washington, D.C., et cetera.
I agree. I think the number one thing is thank you to everyone who endured a somewhat difficult transition, certainly signing stacks of paperwork during COVID when really it was very difficult to be in the office or have clients come into the office. It was challenging. We became DocuSign experts in the process. I'd like to thank our staff here in the office as well as back in Sacramento who have supported us over the last year. It's just been great. And as many of you know, there's really been a nice uptick in the service level that we're able to provide. And I think my closing thought would be, if you have any questions, don't ever hesitate to call either Blake or myself. We're here to help you get the answers that you need. And I think the key underlying trend is we both have more time to spend with clients. And, in your case, you're spending a lot more time with prospective clients, and that's good for the firm. A wise man once said, if you're not growing, you're dying. And we've certainly experienced some nice growth this year. So we want to thank everybody and look forward to doing another update next year.